Warren Buffett, the legendary figure of the investment world, has been known throughout his decades-long career for noticing the silence before the storm ahead of everyone else. The picture we see in the markets today clearly reveals why Buffett holds the largest cash pile in history and why he has quietly stepped aside. As we move through March 2026, the foundations of the financial system are shaking like never before. Buffett's recent moves serve as a warning to those wanting to understand why he rapidly exited giant holdings like Apple and Bank of America. The so-called Buffett indicator, the ratio of total market capitalization to gross domestic product, has reached historic highs, even surpassing the dot-com bubble. This is not just a correction, it is the footfalls of a massive crash. According to the legendary investor, markets have completely detached from their real values, and the end of this unsustainable rise is approaching. A cash position of $373 billion shows that Buffett is not just acting cautiously, but is lying in wait for the opportunities that will arise following the impending disaster. If the world's greatest investor is abandoning ship and taking refuge in safe harbors, this is a signal every investor should stop and consider. Time is running out, and as we stand in this great breaking point of 2026, those moving with the herd will be the ones paying the highest price. Buffett's strategy is clear: be fearful when others are greedy, and be greedy when others are fearful. However, right now, he is whispering through his own actions that the time to be fearful has long since arrived. To protect your money and your future, you must see these deep cracks within the system, because when this crash begins, the exit door will not be large enough for everyone. The turbulence experienced in the markets as of March 2026 is not a surprise for Warren Buffett. On the contrary, it is a long-awaited moment of reckoning. To understand Buffett's strategy, one must look not only at what he buys, but also at when he remains silent. Instead of getting swept away by the current like everyone else during periods of extreme market euphoria, he chooses to protect his capital and keep his cash flow under control. In such situations, Buffett first triggers the margin of safety principle, meaning he puts an asset on his radar not just because its price has dropped, but because it is significantly below its intrinsic value. The massive cash power of $370 billion he currently holds gives him a luxury no one else has while the market collapses: the power to buy time. The greatest insight he offers the audience is this: Buffett does not engage in panic selling during crises because he has already weeded out the weak links in his portfolio before the storm hit and taken refuge in giant, debt-free companies that generate cash. He applies two fundamental rules to grow cash flow. First, he never consumes the incoming dividend income but redirects it back into investments, starting the massive snowball effect of compound interest. Second, he minimizes the margin of error by focusing only on businesses he understands and that possess a competitive advantage. In this uncertain environment of March 2026, Buffett's quiet waiting is actually his greatest move. He represents the patience required to say yes to only the most perfect offer among the thousands the market presents to you every day. Remember, according to Buffett, the stock market is a giant center where money is transferred from the active to the patient, and right now, the strings in that center are in the hands of those with cash and patience. Another key to Buffett's past success is the unshakable discipline he displayed during periods such as Black Monday in 1987 or the dot-com bubble in 2000. While everyone else was rushing into internet companies, he stayed on the sidelines saying, "I don't invest in what I don't understand," and collected companies that produced real value with his cash when the bubble burst. Regarding the growth of cash flow, his rule has never changed. Every single cent of profit obtained is reinvested. He looks not just at the current value of companies, but at the total cash potential they will produce over the next 20 to 30 years. His past investments in companies like Coca-Cola or American Express were not just stock purchases, but a strategy of acquiring never-ending cash machines. Recalling these lying-in-wait tactics from Buffett's past, is enough to understand why he remains silent now in the uncertain atmosphere of March 2026. He has always proven that the right moment, waited for with patience, brings far more wealth than years of wrong transactions. The core strength, lying beyond the numbers, in Warren Buffett's investment philosophy, and the one most often overlooked, is management quality, the very soul of a company. He doesn't just make decisions by looking at balance sheets. He looks at whether the people managing that company handle the money as if it were their own. For Buffett, growing a company's cash flow isn't just about making sales, it's about multiplying those earnings through proper capital allocation. If a company is profitable but squanders those profits in unproductive areas, that stock holds no value for Buffett. This is where one of the most critical concepts comes into play: shareholder-friendly management. Buffett seeks out leaders who are accountable for every penny earned, shun luxury, and possess a long-term vision. Furthermore, understanding how Buffett's distant stance toward technology has evolved over the years is key to decoding his current strategy. For years, the legendary figure stayed away from tech companies, yet he placed Apple at the center of his portfolio because he viewed it not as a tech firm but as a consumer products giant that people simply cannot give up. This demonstrates his flexibility, yet also shows he never compromises his principles. For him, the true economic moat is not the complexity of a business model, but the indispensability of that business in people's lives. In this current period of global uncertainty, companies producing goods that people won't abandon even in the hardest times are the primary targets Buffett is waiting for to deploy his massive cash hoard. When building cash flow, he places great importance not only on dividends, but also on companies' share buyback strategies. If a company is buying back its own shares, it is essentially growing the existing shareholder's stake in the company effortlessly. Buffett views this method as a tax-efficient and silent tool for wealth accumulation. While everyone in the investment world is chasing the fastest rising chart, he analyzes the operational excellence and cash conversion cycles behind those charts. This depth of analytical skill has made him not just a stock picker, but the founder of one of the world's largest business empires. Ultimately, the amount of cash he holds is not just a defense mechanism, it is the preparation for a major strike to be made when the market loses its rationality. The greatest secret underlying Warren Buffett's success is actually an unshakable temperament rather than superior intelligence. He doesn't fly high when markets rise 10% in a day, nor does he fall into despair when they crash 20%. For him, the stock market is not a place where prices change every second, but a meeting point for real businesses and real values. The emotional detachment Buffett displays while managing cash flow is exactly what modern investors need most today. While most people act with the excitement of a gambler looking at charts on a screen, he continues to read balance sheets with the meticulousness of a librarian. Alongside this, one must look closely at Buffett's principle of focus. When he and Bill Gates first met and were asked the secret to success, both wrote the same single word on a piece of paper: focus. Buffett focuses only on the most sustainable investment instruments that he knows best among thousands of options. This ability to focus gives him the power to filter out market noise. Today, the speculation circulating on social media, news channels, or in financial circles is merely background noise to him. While analyzing whether a company can maintain its market position over the next 30 years, he completely ignores short-term price movements. Another hidden path to growing cash flow is cost management. When you look at the headquarters of Berkshire Hathaway, which Buffett manages, you see how far one of the world's richest men stays from luxury and ostentation. This discipline is reflected in his company selections as well. He rewards managements that use money efficiently, avoid unnecessary operational costs, and know the value of every dollar earned. Because to him, waste within a company is essentially future cash flow stolen from the shareholder's pocket. Finally, one must not forget Buffett's advice, which serves as a legacy. Investing is not just about saving money, it is about building a worldview. He knows that no matter how chaotic the markets become, owning productive assets such as land, a farm, or a good company is always safer than holding paper money. The immense cash reserve he holds today is actually a compass he uses to purchase the world's most productive assets.